Welcome back. Well, let's get straight to some fundamental analysis. Sid Khemka, Head Retail Research at Motilal Oswal Financial Services, joins us on the show. Hi, Sid. Good morning. Well, let's talk about LTTS. They had an analyst meet yesterday. The stock is not very, very cheap, but they have given this ambitious guidance in a couple of $1 billion, split it up vertical-wise as well. What do you make of the stock?
Yeah, good morning, Nigel. Glad to be on the show. So if you look at the re-engineered go-to-market strategy, we believe that is really positive given that some of their product segments were a bit confusing for the market. So they have given out an aspiration of achieving a revenue run rate of $2 billion, EBITDA margins in the range of 17 to 18%. And what we believe is that the growth drivers for the company remains intact for some of its key verticals across the ERD client universe. And with the new go-to-market strategy, the company is redefining its segments into high growth areas such as mobility, which is your software-defined vehicles and electrification, sustainability, which is your industrial products, plant engineering, and finally the tech business, which is your medical devices, communication, high-tech, smart cities. So we believe that if executed correctly, this could boost the long-term growth for the company. And this new strategy also opens up new avenues for growth, especially in some of the weak areas such as mobility, which has been a fast-growing area for some of its peers in the ERD space. Hence, we believe that though the near term or the immediate future could be a little impacted by the demand uncertainty, but this strategy of redefining its business and go-to-market strategy will definitely be a long-term positive. Yes, valuations a bit expensive, but with this kind of growth, we are expecting a 10% USD revenue growth over the next 2 years and EBITDA margin somewhere between that range, so about 17.3% EBITDA margins. Hence, we believe the premium valuation would continue. We are valuing the stock at 40 times and giving it a target of 6,300.
Okay, all right. That's L&T Tech Services. Siddharth, good morning. Good to have you on. I just want to get your sense on this company Office in case it's under your coverage. Let me first ask you, is it?
No, we really don't cover that stock right now.
Okay. Fair enough. Recent IPO and it's done really well. But let me expand that question to, in general, I mean, Realty. What's the sense now? Are you looking for any bargains over here? Because we've been going through some of the industry reports when Knight Frank came out with the report, and I saw another one by Colliers basically saying the same thing, that the price appreciation pan-India is very significant. NCR is even better, and unsold inventory continues to fall. So it seems the fundamentals are still in place. The question is getting the right stock at the right price. So any thoughts here?
Yeah, so if you look at the overall real estate space, the pre-sales booking remains quite strong, and we believe that the double-digit growth aspiration for the overall real estate space that remains intact. However, what we have seen is after a spate of large luxury segment launches, now there is a controlled launch that is happening, and that will lead to some kind of a slower growth compared to the last few years. Also, the premium and the luxury segment, which continues to do well. Now we expect with the upcoming rate cut cycle, the mid segment also coming in and doing well with the interest rate sensitive bracket. That should also start doing well. So in our view, what we believe is that the overall there could be a phase-wise launches of some of the key projects which could keep the growth visibility strong. And what we like is now some of these mid-segment residential space companies, for example, your Prestige Estate, Shobha Developers, and Godrej Properties. So these are some of our preferred picks from the real estate space.
Siddharth, your sense on insurance overall, I don't know if you could hear our conversation with Medi Assist on the health side. They're sounding very optimistic, talking 21%, steady state growth, 23-24% margin. So between health insurance, overall life insurance, which has had a fantastic run, or maybe a way to play it could be a TPA like Medi Assist. I mean, how do you play the space and what do you like here?
Yeah, Surbhi. So I think the entire insurance space is finally coming out of the woods post the pandemic, where we saw a lot of pressure on the numbers. Now both life insurance players have reported healthy premium growth, while in the general insurance space also, firms have posted a decent growth underpinned by the strong auto sales, high demand for health insurance. So what we believe is that both would continue to do well in the general space. Health insurance and its penetration in the retail, which is still low, that would drive growth. So what we like within the health insurance or the general insurance is the ICICI Lombard and Star Health. So Star Health is our preferred pick there. We believe that the company would report strong growth on back of the penetration in the retail health industry, so some of its specialized products, as well as deepening presence in the product space. What we are expecting is an 18% NEP growth for Star Health and almost 30% PAT growth over the next 2 years, leading to a target price of 730 for Star Health. ICICI Lombard has been doing well. We have a target price of 2,200, which is almost closer to the target price. The stock has done well. Life insurance, SBI Life is our preferred pick given its efficiency ratios, as well as the strong VNB margins and growth. There we have a buy rating with a target price of 1,900. But in general, we like the entire insurance industry from here.
Okay, all right. Thanks a lot for that, Sid. By the